talk about the biggest data point that the markets will be watching out for today now. That's the industrial production data. And a Bloomberg poll suggests that for the month of August, it will come in at about 2.1% against 2.6%. That was a pleasant surprise that we saw for the month of July. Saloni is here now. Saloni, give us the breakup. Where are we seeing more growth and where can we expect a muted set of numbers?
Tanvi, to begin with, just to give you a roundup of how interesting this month is going to be. Now, we have the IIP numbers today. Next week, we have the inflation numbers, and then, of course, the half-yearly monetary policy slated for the 29th of October. So, quite an interesting month. And to begin with IIP, now there's a huge diversion in terms of the estimates that have come this time. Now, a set of economists suggest that IIP will, in fact, expand to nearly 4.8%, and the other spectrum believes that there will be nil growth. But an average estimate here suggests that it will be close to 2.1%, clearly on the back of a huge jump in numbers as far as both manufacturing and electricity is concerned. We even saw the last month IIP jumping on the back of manufacturing data, and even the core sector data has improved. So clearly manufacturing and electricity will be two key indicators to watch out for, because we've seen IIP showing some signs of revival, because in the last 2 to 3 months we've seen some sort of contraction and then improvement again in the last month. So clearly the street definitely expects that it will be a positive IIP again this time.
So Saloni, let's put this more in perspective in terms of your other macroeconomic indicators. There is some expectation that the CAD could be lower than what was earlier estimated, but inflation still remains a concern?
Absolutely, Tanvi. Now, to begin with rupee, now that is giving the highest concern as far as all these macroeconomic data points are concerned. Now, rupee has seen a jump of almost 5% in the last 1 month, so that is also giving RBI some scope as far as liquidity easing is concerned. Now, to look at some of the other positives, now we saw CAD close at around almost $21 billion. There was an expansion there, but not as what was expected by the street. Of course, there are some other economic indicators like the trade deficit. Now, that has narrowed significantly. Now, from $18 billion last year, it stood at around $6.76 billion. So that is giving some sort of ease as far as the street is concerned. Also, in terms of the oil and non-oil imports, that has also eased. We've seen several brokerages cutting the CAD estimates. So clearly some positive factors as far as that is concerned. Also, like I mentioned earlier, there is expectation that manufacturing and electricity will be showing some improvement going forward. But the weak indicators definitely are the GDP growth. We saw PMAC cut down the GDP estimate. Even the RBI said that though they are not cutting the estimate right now, but there is a downward bias as far as GDP is concerned. Those that still remains a huge area of concern. And also the mining issue, there is no resolution in the mining issue, and that could lead to stress on the external front. And also lastly, inflation. Now we're seeing both the WPI and the CPI remain on sticky levels. Now WPI has come around 6.10% for the last month. CPI, of course, hovering around the 9.5 to the 10% mark, well above the RBI's level. Food inflation around the 18% mark. We've seen vegetable prices remain sticky. That is playing spoil sport as far as inflation is concerned. So going forward on the 29th, the Street X estimates that the RBI stance will still remain hawkish as far as inflation and growth indicators go.